And actually, Robert, before we get to your buckets, I mean, Sheila and Josh were just talking about the fact that this volatility has actually been a trader's market. I mean, options traders are having a field day with all this volatility.
Well, I did see the segment, Betty. Good morning. And you pointed out that options volumes are up. We just don't know whether that options volume is used by traders or investors. My guess is traders are using the option volume. And I would also tell you, Betty, that I think it's a very tough time to be a trader, a much easier time to be an investor right now.
Why? Given all the volatility, why?
Well, if you think about it, a few weeks ago, traders were worried about a correction in the market. We finally get a correction in the market. Maybe they go short last week. And then yesterday, as you know, we have one of the biggest up days and look like we're positive today. So the market's pivoting very quickly back and forth. And if you're a trader, it's a very perplexing time to position a portfolio. Now look at an investor. An investor today, stocks are cheaper today than they were even a month or two ago. I think we were 14 times forward earnings a month ago. Today we're 13 times. If you're an investor, you want to buy good quality stocks at cheaper prices. Today that strategy is in play. It's a great time to be an investor.
Robert, it's really been all about central bank option, you saw China rate cut this morning. We're going to hear from Bernanke later today. How is that changing your mindset as an investor?
Well, it doesn't so much because as an investor, you're thinking out 3 years, 4 years, 5 years. So the short-term moves of central bankers are not a big concern for investors. I think it's more a concern for traders. But what I would tell you is that it does make the landscape more complex, more confusing. I think politics is more intertwined with the economy right now, and that can cause people to be unsettled, but it also creates the opportunity for investors.
Hey, Robert, it's Josh. Let's talk about your trading bucket. I know you're not a trader, but you'd be selling bonds. What's your thesis there, Robert? How come?
Well, yeah, I mean, if you're going to make a bet for the next 3, 5, 7 years, I can't see how you make that bet, generating a 1.5% average annual return in your portfolio. That just doesn't make any sense to me. That's not a good long-term strategy. Even buying the dividends of the S&P 500 will beat that. So that's not a good long-term strategy. It's a short-term strategy if you're trying to protect capital in the short run. You're trying to protect, 100 cents on the dollar over the next several months. That's a trading strategy. So if I was thinking about putting money to work for the next 3 to 5 years, I would take money out of the trading bucket, which may be your bond portfolio that you're trying to protect downside capture, and put it a little bit more to the long-term side and not be too concerned about the volatility.
Quickly, Robert, before we go, though, tell me what you expect to hear, what you would like to hear from Bernanke today.
Well, I think he's telling us, and you got this from Janet Yellen last night also, is that they have their eye on 3 indicators. What is inflation going to do? What is unemployment going to do? And what is the overall economy going to do? If these are the litmus tests for QE3, we need to be looking at that. And the fact that that's what the Federal Reserve is doing gives me confidence that they've got their hand on the steering wheel and they know how to drive this thing going forward.